All right, so this is the step-by-step strategy that took me from being an unprofitable day trader and blowing sets of evaluations consistently to pulling real-time payouts from Top Step, Alpha Futures, and more, much more than you see on the screen right here. The biggest misconception from becoming unprofitable to actually becoming a profitable trader within your strategy is the timeline in between. And so a lot of traders think that they can set this timeline right here on a certain horizon, and that's honestly not how it works. You set your own timeline within this journey, and what the point of this video is going to be is to teach you my strategies that help me become profitable within 9 months of trading. So like I said earlier, some traders take 3 months to become profitable, some 6, some take 2 years to become profitable, and some take 5 years to become profitable. And the thing that you'll notice with all these traders is that regardless of having a strategy or not, it comes down to simplicity, simplifying everything in your trading. And so that is why I made my strategy as simple as I could make it. And that is the point of this video, to explain that to you. And so a lot of traders that you'll notice, they focus a lot on psychology, they focus a lot on discipline, they focus a lot on risk management. And well, these things aren't typically bad, and these are very good things you want to implement within your trading, and that I also use as well. Strategy is a very, very key component to becoming a profitable day trader. And I realized that I was focusing so much on these things as I was coming up in trading, because that's all people push. It's just psychology, discipline, risk management, yada, yada, yada. And even I push this on my channel too. I'm, accounting for it as well. But a lot of people don't actually focus on the trades that they're taking and the strategy that they're taking to become profitable. And I will put this as a disclaimer, is that any strategy that you do trade can be profitable if traded the right way. And so the point of this video is to teach you the strategy that made me profitable and help you along those ways. So all you need to know, and the biggest thing I'll teach you before going into the video, is that your strategy is the backbone to all profitability. Yes, you can have all these things like I just said, but if you do not have a strategy that you know to the T, then everything else will be fluctuated. Your numbers will be fluctuated, your win rate will be fluctuated. Nothing will be consistent within your trading, because if your entries aren't consistent, what you're looking for on a day-to-day basis isn't consistent, then none of this shit up here matters, because this is all just fluff, because your strategy is just so up and down. And so, quick disclaimer, if you're not familiar with ICT concepts, please go watch the ICT mentorship before watching this video, because a lot of the terms and the things that I use in this video are related from ICT, and I trade a very similar ICT continuation model. Without further ado, we get into the video. So with the ICT continuation-based strategy that I teach, I break it down into a very, very few simple steps to make it as simple as possible for you guys to learn. And no, I don't have a name for this strategy, because I feel like that shit's goofy. I just name it ICT continuation-based strategy. I feel like a lot of traders try to quote. A lot of traders you'll see out on the internet will try to name a model, and I found that shit fucking corny. You're just putting a bunch of confluences together. Anyone can trade the same shit as you. Doesn't really make sense. Anyways, the first thing that I look for is narrative and higher time frame. And so the reason I want to do this is because we want to understand what the higher time frame is doing. Are we rejecting or displacing out of any higher time frame PD array or drawing liquidity? The first thing that we want to do is identify what the weekly, the daily, and the 4-hour are doing. The reason is the higher time frame is king. So if we can get a good narrative and a good idea and bias on what the higher time frame is doing, then we can zoom in and implement that on the lower time frame. Another big thing that a lot of people really don't use is understanding news and current economic events. So whether we're in a war, whether there's tariffs going on, whether Trump is tweeting things, whether there's things happening within the stock market or businesses or anything, you always want to be up to date with current economic events, because that is also what moves the market as well as smart money. So you want to understand what's going on at all times. Obviously, when Trump is announcing tariffs, we're bearish. When Trump is pulling these tariffs away, we're bullish. When we're in wars, we're typically bearish. When we're not in wars, we're typically bullish. NASDAQ, the main asset that I trade, is typically a bullish asset, unless we're in some type of event that's going on for a longer period of time. So the reason we do this is because this gives us bias and clarity for what is next. An example of this, as you can see right here, is this is NASDAQ, the main asset that I trade. As you can see here, at the bottom, we have a liquidity sweep, and we have this displacement to the upside that looks very, very nice. And we have a retrace on the higher time frame. Now, this is the 4-hour time frame that I'm using in this picture right here. And so what you will notice is that we are rejecting out of this 4-hour fair value gap. So knowing that we have all-time highs above us, we're overall bullish on the higher time frame. We swept liquidity, and we're also balancing out of a 4-hour fair value gap. That tells us that the higher time frame is bullish. We have nice draws higher, and you also want to market draw lower just for safety in case we do flip. But we have very, very nice draws higher. We have an untapped 4-hour about to displace into. We have a previous day high right here, and we have an untapped 4-hour above us. And then obviously we have all-time highs resting way, way above. So knowing this will help a lot of times with the narrative and the lower time frame entries, because we know that ideally we should be longing in these situations. yes, your entry model and your strategy really do matter a lot, but also just understanding where the market goes plays probably 90% of the role in the trades that you're taking. Because if you're trying to short right here to Asia lows, but we're rejecting out of this 4 hour and we have clear draws higher, you're going to get fried no matter what strategy you're taking. You know what I'm saying? So strategy matters, but narrative and context behind the trades that you're taking matter a lot more. And that's why we use the higher time frame, the daily, the weekly, the 4 hour, the 1 hour to identify where are we rejecting out of, where's our draw on liquidity, where are we displacing, and et cetera, et cetera. Now, the second thing is my actual trading model. And so I simplified this into a 5-step process. The first thing being liquidity, second thing being displacement. We get our pullback, an entry, and a target. As simple as that. So with the liquidity, what you want to see is a liquidity grab, whether it's internal liquidity or external liquidity. And all that means is when we're taking out a drawn liquidity on the higher time frame or the lower time frame, typically if it's an internal, it may be like a lower time frame swing high or swing low. If it's external liquidity, it's usually a higher time frame, swing high or swing low, or a drawn liquidity that we take out in the higher time frame. For displacement, all you want to see for displacement is volume towards the drawn liquidity. You don't want to see us chopping and wicking up and down because a lot of times those are the market conditions that you get fried in. So you want to have very, very good displacement. And the best session to trade that has the most highest volatility and the best displacement is obviously New York session, which is what I trade and which is what I teach. Third thing being confirmation. So typically we can get confirmation with a market structure shift or a change in state of delivery. So typically once we take out some type of liquidity, we want to see market have a CISD or MSS to the upside or to the drawn liquidity, because that gives us the confirmation on, hey, order flow is changing, market structure is changing, we're going higher or we're going lower depending on the case. And that gives you a lot more clarity going into the trade. Retrace. Now, this is probably the most important thing right here, because if there is no retrace, there is no fucking entry. And I don't know how many times I've seen myself and other of my students get completely fried trying to long or short when the price is overextended. I always wait for a retrace because you always want to be getting the best entry into the market. You never want to go to Walmart and go buy a TV at the highest price when we have deals going on the next week. You want to always get the deal when it comes out, if that makes sense. So with our retraces, we want to see us retrace ideally into a lower time frame FVG. So this could be like a 1 minute, a 5 minute, a 15 minute, a 30 minute, something in that area that we retrace into. And then after that, for our continuation entry, we want to get an inversion fair value gap that is rejecting out of that fair value gap. So all we want to see is, hey, do we tap into that 5 minute gap, and do we reject out of it? And when we are rejecting out of it, the way that we enter is off of an inversion fair value gap. Now, I'm not going to specifically say which time frame you should be entering off of for the inversion fair value gap. Some people enter off the 15 second, some people enter off the 30 second. I personally like entering off the 1 minute. I like 1 minute entries for my inverse fair value gaps. So that is what I recommend. So if you guys want something to have to take away from this video, I'd recommend 1 minute inverse fair value gaps. And then obviously your TP, your take profit should always be at the drawn liquidity. So an example that would be like London highs. So here is a model example of literally everything that I just said. Obviously you can see coming into the day that the higher time frame is bullish, and the lower time frame is bullish prior to the trade. So before we even think about entering along right here, I want you to pay attention to how the lower time frame comes down and we tap into the sell side liquidity and we sweep it. Now, after sweeping the sell side liquidity, the way that we know that we have confirmation and order flow is changing back to the upside is when we get this change in state of delivery or market structure shift right here. This is the confirmation for the trade. And all that means is when we close or wick above the most previous swing high or the swing low, that gives us our confirmation knowing that we're going higher. So once we get that confirmation and we have good displacement higher, we want to see price pull back and give us a retrace, ideally into a fair value gap. So you can see that I drew price retapping into this fair value gap right here. So this could be on the lower time frame or the mid time frame. Ideally, like I said, the 5 minute, 1 minute, 15 minute, anything like that. Once we tap into that, all we want to see now is an inversion to the upside. So where my entry will be at, let's say there's like a 1 minute inversion right here. That is where we'll be entering at once price closes above the 1 minute inversion right here. Once we do get this close above this 1 minute fair value gap right there, that is typically where I like to enter at. Typically with stop loss, you can put your stop loss below this swing low depending on where the trade is. Obviously, most trades are different than another. Me, typically, I run a set 25-point stop loss, risking $500. If you want a wider stop loss, as I trade like one contract on NQ, then you could go down to MNQ and then you get just a wider stop loss that way. So for me, since I trade one contract, I usually have like a 25, a little bit more sometimes depending on the trade if I can get my stop loss wider. And then as far as my break even, I always go break even an internal high just like how you see right here in the diagram, and then enter off of a 1 minute, 2 minute, 3 minute inversion. Typically, the higher time frame, the better on these inversions, just because it gives you more cushion and safety in the trade. You can enter on like the 15-second, the 30-second. Those are good too if you want more like precise entries, but those ones are a little bit more like intermediate level, expert level for trading. And then obviously TP should always be buy side liquidity. You always want to have a target in your trade. In my opinion, this is probably the most important part of a trade because you can get away with having a loose entry, but if your target isn't good, then a lot of times you're gonna get fucked over in your entry. So in my opinion, you can get away with having the loose entry as long as your draw on liquidity is valid. So draws on liquidity that I like is usually like data highs, session highs, session lows, and things of that sort. So I hope this diagram really helps you guys. You guys can take a screenshot of this if you want to. I'll zoom in just a little bit as well. And that is basically the fundamentals of my model and how I like to trade. The last thing that I'll go over here is just my trade management and my rules. So typically how I like to trade, because I have about a 60 to 70% win rate in the live market, is I like to go for a 1 to 2 RR. And this helps me sustain profitability over a longer period of time because number one, I really don't like losing. And number two, when I take my wins, I want my wins to be minimum double than my losses. So at least am a lot like my mental is a lot better when I take these losses, knowing that my win can double it or triple it. So usually 1 to 2 RR is the minimum. If you can't get a 1 to 2 RR, depending on what the draw's at, you can scale down to 1 to 1 if that's something you want to do. But for me personally, I always go for 1 to 2 minimum. Sometimes the draw on liquidity is a little bit further, so you can really get away with going for like a 1 to 3, depending on like where the draw is at and whatnot. So stop loss is usually always below liquidity, like how I showed you guys below that swing low. Sometimes you won't really have a nice swing low or swing high to put your stop loss below or above. So you can put it below the fair value gap, like if we disrespect the fair value gap and invalidate it, or if there's a fair value gap under the trade, then you could put your stop loss under that. So really, this is more like a discretionary way to have your stop loss. Obviously, break even should always be at internal liquidity. If we don't have an internal liquidity, let's say like we don't have a nice swing high or swing low in the trade, then you could also put your break even at a fair value gap. So let's say we're in a long and we have like a let's say we have like a 1 minute fair value gap like right here. You could go break even at this point right here, rather than like waiting for some type of internal liquidity. If your on liquidity was internal liquidity, that makes sense. So last thing is that I only trade this during New York market open. The reason because is like I said earlier, it's the most volatile time. It's the easiest time to get in and get out of a trade. And I only take 1 trade per day. If I lose or win, I'm at 1 trade per day. If I go break even, then I allow myself to take another trade if the draw on liquidity is still valid. And the major thing that I want to emphasize to you guys is that if the setup does not present, then do not trade. Sometimes I get caught up in taking bad setups, and I've really learned to just be a lot more patient in the market. And I see a lot of people in trading get completely fucked over from taking just a bad setup when their setup doesn't present. And I know it's very easy to get caught up in that thought process of, oh, I got to trade every day. I got to trade every day. But a lot of the times not trading is also way better than forcing a trade in the market, because if you force a trade, you're down 500. Let's say even if you have your risk management and all those things, you're going to be down 500 on a trade you know you should have never taken, rather just walking away from the day with $0 and being even on the day, and then going into the next day up that $500 that you avoided losing, if that makes sense. So again, these are my trade management rules, and that is basically my 3-step process on my strategy. So again, number 1 is just higher time frame narrative, understanding where the market wants to go. Number 2 is just my model. So I look for liquidity, displacement, a pullback, entry, and a target. And then number 3 is my trade management and my rules. So how I'm managing the trade, my RR, where my stop loss is at, etc. All right, and so the last thing that I kind of want to go over for you guys is just an A+ setup example of what I'm talking about. I feel like it would be very, very easy for me to explain these when looking at an actual live chart example. So first thing you want to understand is the narrative and bias. We have data highs to the left at this high right here. And then above that, we have London highs right here that was left with another high behind it that you can't see. Overall, higher time frame was bullish. And then we have bullish structure on the lower time frame. We have our liquidity sweep, which is down here. We swept out London lows, which is resting below us. Immediately off of open, we manipulated those lows. We have clean displacement. And so one thing I want you to notice right here within this trade is that look at how market opened right here. You can see that we're displacing very, very bad. We are wicking aggressively in both directions. So once we actually got good volume and displacement and confirmation, this is when we actually want to look for a trade. So displacement, and the next thing will be a retrace. So once we got that displacement confirming that we want to go take out these data highs and London highs up here, now all we need is a retrace. You can see we get this retrace sequence into a 5-minute gap that's resting below. So price pulls back into this 5-minute gap. The next thing is we get the confirmation out of the sweep plus a market structure shift. So number 1, I want you to pay attention that we sweep these highs and these highs right here, giving us confirmation that we're going to go higher. And then once we reverse and reject out of this 5-minute gap that's in this area right here, Obviously, this is the 1 minute, so you can't really tell. But once we reject out of this 5 minute gap right here, that is the confirmation that we want to see to now enter. And so for entry, we wait for a 1 minute inverse for value gap entry for confirmation. This trade specifically, I let the trade close and then I waited for the retrace and I entered once we retraced it. So I could have entered at this close up here or entered once we got a small pullback. But again, the same thing applies here. 1 minute entry inverse for value gap for entry. And then again, as you can see, we go break even at the internal high, which is right here. And then we have full TP at London high. You could have took TP at the data high right here, but I was convicted and I was just completely running while we were taking this trade. So I really, really like this. And next thing will be just the drawn liquidity, which I just kind of went over, which is data highs and London highs. So we have data highs right here and we have London highs up there. And so those are the two value draws that we want to target. So obviously this is a nice A+ setup. Once we check all these boxes, that is the criteria for A+ setup. And so anything that does not have all the things listed to the right that you see right here, narrative, liquidity sweep, displacement, retrace, confirmation, entry, and a good draw in liquidity, then it does not list as an A+ setup. So a lot of times what you'll notice is that the market doesn't give these setups out every single day. The market will not typically give you A+ setup every single day, especially trading this strategy at least for me. It usually happens about like a few times a week. So you want to capitalize when the setup presents. What you will notice though is we'll get setups that will be similar to this. Like let's say for instance we don't get a liquidity sweep, right? And we get everything else. We can still take the trade, but it's not A+ anymore because we don't have everything checked off to make it an A+ setup. It might be an A- setup. Or let's say we don't have good displacement or we don't have a good entry. Let's say we don't have a 1 minute inverse for value gap entry and we enter a little bit loosely off of the trade. Then obviously it's not as good of a setup or not as high rated of a setup that it could be. So when you're grading your trades, typically how I go about grading my trades is I see, number one, what is A+ setup? And my A+ setup is literally all these things that I have written here. All these things are my A+ setup. And then number two, if everything checks off, then it's A+. If everything doesn't, then the more things I check off is the less of a grade that it is, if that makes sense. So, obviously the less things you have here, go down to a B setup or C setup. And that just kind of helps you understand what setups are better than others. And you really want to get a crystal clear picture of what an A+ setup looks like with your trading strategy and with this trading strategy as well. So besides that, that's really all I have for you guys. I truly hope that this video is informational. I know a lot of you guys have been asking me for videos on my continuation model, how I trade my ICT continuation model, what I look for. And this is a very, very simple explanation on front to back how I trade. Now, if you guys want more in-depth videos, I do have a coaching program you guys can apply for in the link in the bio. If you guys want more videos like this, I'll keep more videos coming out as well. And thank you guys for tuning in, and I'll catch you guys in the next one.